A big hello to all of you. Hope you're all doing well and your preparation is on track. Today I'm in front of you to discuss one of the key changes that was made in the current annual financial statement, also popularly called as Budget 2024. You see, this year it was very interesting because we got two budgets. One was interim budget 2024 and then there was a union budget, the full-fledged budget, which is called as annual financial statement. This we have already discussed. At this one, we are going to look at one of the key aspects which was covered in this year's budget related to taxes and specifically capital gains tax. Now, have a look at the board, please. You can see on the one side of the board, you can clearly see that there is a share. So if you buy the share of a company, so for example, suppose that this piece of paper is the share of a company. When you buy it, you have to pay some capital to the company, and in return, when you buy the share, you get ownership. So suppose that I'm buying the share of a company for 1 lakh rupees today. And suppose tomorrow the value of the company increases. I can go in the market, capital market, and I can sell this share for 3 lakh rupees. 2 lakh rupees will be my gain. This type of gain is called capital gains. Similarly, suppose you buy a house and suppose the price of this house is 20 lakh rupees. You bought this house 5 years back. This year you decide to sell this house for 1 crore rupees. So what is the capital gains? Capital gains is 80 lakh rupees. Now, suppose that in your family somebody has bought a gold ornament or jewelry. Focus on the gold only. Now suppose the price of this gold is 1 lakh rupees. You bought it today. And after 3 years, you are going to sell it for 5 lakh rupees. So what is the capital gains? 4 lakhs. So what did we see? That there are various type of assets which you purchase with a hope that in future, its price will appreciate and then you can sell it at high price so that you can incur capital gains. The government of India is watching you and the government of India loves to tax people in various ways. So when the government of India sees that you bought a share, you bought jewelry, you bought a house, and then you are selling it at a higher price. So whatever is the gain, the government of India will come and put a tax over it. This type of tax is called capital gains tax. Let's revisit a little bit and see what actually transpired in the parliament when the government of India made some changes in the capital gains tax of India. So you can clearly see I have got this news clip for you. So this news item says that capital gains tax framework completely overhauled, which means that something big happened in this year's budget. When this happened, one of the member of parliament, he raised a voice in the parliament and said that we have taxes like UK and services like Somalia. And he gave a reason to the government of India that if you make these changes permanent, which you have suggested in the annual financial statement, then because of that, the circulation of black money will increase specifically in the real estate. This was the concern raised by the member of parliament, Mr. Raghav Jadda. Now, of course, he is a chartered accountant. He showed it through calculations and we all saw what he said. And there was some element of truth in it as well. So what did the government of India do? The government of India made some changes based on the public reaction. And the news headline read, roll back after criticism, the government brings back indexation benefit on the sale of property purchased before budget. Which means whatever government did, they didn't change it completely. They didn't reverse it. But they made some changes in it after the reaction of the public as a whole. So in this lecture, we are going to understand what actually is the capital gains tax. What was the system of the capital gains tax earlier? What is the system of the capital gains tax now? And what are the implications on the economy because of this? And we are going to do all this from UPSC perspective. So let me show you the UPSC angle to this very popular news item which was floating around us. So guys, for UPSC purposes, the memes are not important. For UPSC purposes, solid knowledge is important. So you can clearly see that assets are of two types. Assets can be of multiple types, but for our purpose, we are dividing the assets into two types. The first type of asset is called as property. Now, properties we are dividing into two categories. One is tangible, which you can touch and feel. For example, if you are buying land, if you are buying building like a house, etc., that's tangible. Then there is intangible property. For example, I develop a mobile app. I am the owner of a copyright. I am the owner of formula of a medicine. These things you can't touch and feel. So these things are intangible properties, right? Now there is another type of property which is like securities. For example, shares, bonds, debentures, all these are financial assets. So I'm putting them under the category called securities. Whenever you purchase these kind of properties at a certain price and then you sell it at a higher price, the difference is called as capital gains. So for UPSC purposes, this is the first definition that becomes important for us. What is capital gains? The profit or the gains by selling capital assets is called capital gains. Now, imagine this, that this piece of paper, imagine that is a share of a company. Let's say I bought the share of TCS today. Now I am holding this share, for example, for 11 months. These 11 months time period for which I am holding this share is called holding period. And suppose that exactly after 11 months, I sell it to somebody else. Now, I bought this share for 1 lakh rupees and within 11 months, I am selling it for 3 lakh rupees. If you take the difference 2 lakh rupees, this is called as capital gains. The government of India will come to me and ask me that, hey, what was the holding period? Was it more than 12 months or was it less than 12 months? Obviously, in this case, it's less than 12 months. I'll say less than 12 months. And then the government of India will say, what is this asset? I'll say shares. Immediately, government of India will say that, okay, since you held it for less than 12 months, the government of India is going to put a tax over this gains that you have made called as short-term capital gains tax. Why? Because according to Government of India, if you hold a share for less than 12 months and you sell it, the gain that you make is called a short-term gain. And the Government of India puts a tax called a short-term capital gains tax. But suppose I bought the share of Tata's today. Now I am selling this share after 12 months. Let's say after 1.5 years or 2 years. The gain that I will make is called as long-term capital gains. And the tax which will be imposed over it will be called as long-term capital gains tax. This is the first thing that is important for UPSC, which means we have understood one thing. What is the definition of capital gains? We have seen various types of assets. We also understood that whether the gain is short-term or long-term depends on 2 factors. What is the asset in question? Number 1. And number 2, what is the holding period? So for shares, for example, TCS, I took the example of Tata's. Tata's are listed companies. So for them, the holding period is 12 months. But suppose that I buy a house today and then I am going to sell this house in less than 2 years. So the gain that I make is called as short-term gains. And if I hold the house for more than 2 years and then sell it in the market, the gains that I get out of that is called as long-term capital gains. Which means that depending on the type of assets and the holding period, we have different definition for short-term gains and long-term gains for different capital assets. For shares, 12 months, and for things like house, jewelry, etc. is 24 months. So the first big change which the Government of India has done in the budget is that the holding periods earlier used to be 12 months, 24 months and 36 months for different type of assets. This 36 months has been removed and the government has said that there will be only 2 holding periods, 12 months and 24 months. So if the asset in question is the share of a listed company, or if the asset is in question is, for example, equity linked funds. What is equity linked funds? Equity means this share. So for example, if you talk about equity mutual fund, it is called as equity linked fund because the basis of equity mutual fund is shares. So if you take the shares of a listed company as well as if you take equity mutual funds, the holding period is 12 months. For everything else, the holding period is 24 months. Easy now? It's very easy for UPSC prelims as well as mains. Now, once you have understood this, let us go to the next part to see where actually the real problem is. Now, guys, let's repeat this example that suppose there is a company called TCS and suppose that you imagine that you have bought a share of this company. This company is listed company, isn't it? Now, suppose that you bought the share at Bombay Stock Exchange. The price of the share is let's say 1 lakh rupees. When did you buy the share? 2024. Now suppose you sell this share for 3 lakh rupees, right? Now what is the capital gain that you make? 2 lakhs. 2 lakhs is the capital gain. Now I told you that if you sell this share in less than 12 months, then Government of India will call it as short-term capital gain, right? And if you sell it after 12 months, it is called long-term capital gains. So currently, the system that the government is following is, if you sell this share in less than 12 months, then Government of India will come to you and ask you that, hey, what is the capital gain? It's 2 lakhs. Now, Government of India will put a flat 20% tax over it. So what is 20% of 2 lakhs? 40,000. So 40,000 becomes the short-term capital gains tax. But if you are selling this share after 12 months, let's say in 13 months, 14 months, 2 years, that's called as long-term. So Government of India currently will come to you and put a flat 12.5% tax on the amount of capital gain which is above 1.25 lakh rupees. So see, I'm going to repeat this for you. So for short term, what did the government do? If you sell this share in less than 12 months, government will simply come and ask you that what is the gain you made? You will say 2 lakh rupees. Immediately government will put a 20% tax over it. 40,000 rupees done. But if you are selling the share after 12 months, the Government of India will come to you and ask you that what is the capital gain you made? You will say 2 lakhs. Then Government of India will tell you that, okay, what is the capital gains you made over and above 1.25 lakh rupees? So on this entire 2 lakh rupees, government will not take a tax from you. Government of India is going to subtract 1.25 lakh because till the profit of 1.2 lakh, long-term capital gains tax is not applicable. Long-term capital gains tax will be collected from you only if the capital gains that you are making is above 1.2 lakhs. So what is the difference between 2 lakhs and 1.2 lakhs? 75,000. Which means this 12.5% long-term capital gains tax will be collected on 75,000 rupee. So this 1.2 lakh is the concession. So which means that total 9,375 rupees will be collected. This is one example of how short-term and long-term capital gains tax these days are applicable after the budget. I'll give you another example. So let's take another example of a house. So suppose that you have purchased a house in 2024, let's say, or 2004. So suppose that you have purchased a house in 2004. What is the price of the house? 20 lakh rupees. Now, in 2024, which means almost after 20 years, let's say you decide to sell the house. So I told you that if you sell the house after 2 years, holding period of 2 years, 24 months, then the gain that you make is called as long-term capital gains. But if you sell a house in less than 2 years, the gain that you make is called as short-term capital gains. So now imagine that you bought this house in 2004 for 20 lakh rupees. You sell it before 2 years, which means that 2004, 2005, 2006. So you don't wait till 6. In 2005 itself you sell it. See, less than 2 years, 24 months. So Government of India will come and ask you, what is the capital gains? So see, you are selling it for 1 crore rupees. You purchase it for 20 lakh rupees. The difference is 80 lakhs. This 80 lakhs becomes your capital gains. The moment you tell this capital gain, the Government of India will calculate the tax bracket, the income tax bracket under which you normally fall. So suppose based on your regular source of income, you fall in the tax bracket of 15%. These are the tax brackets currently. See, 5%, 10%, 15%, 20%, 30%. And to begin with, there is a tax bracket which is nil. So the Government of India will find out under which tax bracket do you fall. So suppose you fall under the tax bracket of 15%. So on this capital gains 80 lakhs, 1 crore minus 20 lakhs is 80 lakhs. The Government of India will charge you 15% short-term capital gains tax. But if you sell this house after 24 months, which is 2 years, then the Government of India will calculate the capital gains, which is 1 crore minus 20 lakhs, 80 lakhs. And here the government will calculate 12.5% of 80 lakhs, which is 10 lakh rupees. This becomes your long-term capital gains tax. So if you purchase a house, the holding period is 24 months. in case of shares, the holding period is 12 months. And I gave you a funda that whenever you talk about the shares of listed companies and equity-based funds like equity mutual fund, etc., the holding period is fixed in India now. It's 12 months. For everything else, it is 24 months. So in UPSC, it is so easy because now suppose that I ask you a question. What is the holding period for gold jewelry? Obviously, gold jewelry is not listed share. It is not equity linked fund. Answer is holding period is 24 months. Super easy. So let me show you in the form of a table about how the government of India has made the changes. See, so guys, if you look at the table carefully, here I have put short-term capital gains tax. Here we have put long-term capital gains tax. Now see, what have we done? Listed securities and equity funds. And in the bracket, we are putting the holding period 12 months. Now you can see the unlisted securities, which is the companies which are not listed in the stock exchange, Bombay Stock Exchange or National Stock Exchange, mostly the startups. So see, for them it is 24 months. I told you that only for these two it is 12 months and here it's 24 months. Movable and immovable property. For example, gold jewelry, movable property, house, immovable property. So holding period 24 months. So if you sell anything in the form of listed securities or equity fund before 12 months, then you will have to pay short-term capital gains tax. But if you are selling the share after 12 months, you will fall here, which is long-term capital gains tax, which means greater than 12 months, greater than 24 months, and greater than 24 months. So now let us look at the tax structure. This is the new tax structure. So in case of listed shares and equity funds like equity mutual funds, if you purchase the shares today and sell it before 12 months, then the government will collect 20% tax from you. Earlier the tax was 15%, which means this has increased. But if you have purchased the share of unlisted company today and you sell it before 24 months, then earlier also the government of India used to collect the income tax slab rates from you, and now also whatever income tax slab rate applies to you, they will collect that tax only, which means no change here. Similarly, if you buy a house or gold, etc., and if you sell it before 24 months, again income tax slab rates will apply, which means these have not changed. The change is here. Let's look at the long-term capital gains tax and let's look at the change. So remember, I gave you the example of the house, that if you have a house and if you sell it after 24 months, it is called long-term capital gains, 80 lakh rupees. And what did the government of India do? The government of India told you that, okay, over this, we are going to apply 12.5% taxes. So let's see. In case of long-term capital gains tax for movable and immovable assets, earlier, the government of India used to collect 20% tax. So if you buy a house and sell it after 24 months, the government used to collect 20% tax plus star. I will tell you what the star is. But currently, the government is putting a flat tax of 12.5%. Should we be happy? We don't know. We'll see. Now, I also gave you one example here of the share of a company called as TCS. And here I told you that, for example, if you buy the share today of TCS, which is a listed company, and then you sell it in the market after 12 months, the gain that you make is called as long-term capital gains. See, after 12 months, it is called long-term capital gains. So in our example, we bought the share for 1 lakh, we sold it for 3 lakhs. So the capital gains was 2 lakhs. But I told you that the government of India says that tax will not be applicable over 2 lakhs. It will be applicable over 2 lakhs minus 1.25, which is 75,000. On 75,000 rupees, you will have to pay 12.5%. So let's see. For listed securities and equity funds, 12.5% over and above 1.2 lakhs. Earlier, before the new budget, it was 10% over 1 lakh. Currently, it is 12.5% over 1.2, which means if I bought a share for 1 lakh and I sell it for 3 lakhs after 2 years, what is the profit or the capital gains is 2 lakhs. According to old system, the government of India used to subtract 2 lakhs minus 1 lakh, and over 1 lakh, I have to pay 10% tax. Now the government of India says, no, from this 2 lakhs, you subtract 1.25, 75,000, and over that, 12.5%. That's the difference. So this is the big difference which has come. But then what is this star? Why did we put a star over here? The whole story and the whole debate is about this star. But to teach you what is this star, let me first give you a basic concept called as cost inflation index. Once you understand the concept, this star will become very clear to you. So let's go and study that. Now see guys, I'm giving you one example, okay? So now imagine that there are few things which you consume on daily basis. So we are in urban area. Imagine that you are in urban area like Delhi, Mumbai, etc. Now suppose that you are using this pen regularly, you are using clothes regularly, all right, you are eating food regularly, all these things, transportation and everything. So do one thing. Take a box like this, something like this. Take a box. In this box, what you do is you put the pen, you put the potatoes, tomatoes, you put the fruits, vegetable, clothes, whatever you do, you put everything in this box. In which year? So suppose the year is 2022-23 and you are in urban area. Then I will ask you a question that what is the monetary value of this box? Because you are going to put the things that you are using on daily basis, right? So suppose the monetary value of this box is 100 rupees. Right? Now, take the same box next year, which means year 2023-24, same box. Check the price of this box. You will see, in most of the cases, in general, you will see that things have become costly. For example, earlier the price of the pen was 10 rupees and you will see next year the price of the pen will become 11 rupees. So what do we see here? That things will become slightly costly. Same box whose price was 100, now the price of this box becomes 107. This 107 is called CPI urban. If somebody will ask you that what is the consumer price index for urban area, you can clearly see 100 to 107 is 7%. Now what the government does is, in fact, Central Board of Direct Taxes, CBDT, what they do is, they say that between 22 and 23, the increase in the price of this box is 7%. So what they do is, they calculate 75% of 7. So if you calculate 75% of 7, you will get something around 5.25. Let's take it to be 5, right? So now they say that this 5%, if you add it to 100, because last year the price of the box was 100, so jump was 7%, but you calculate 75% of the 7, roughly around 5. I'm ignoring the decimal. Now you add this 5 in the price of the box. So now this number becomes 105. So 100 becomes 105 because you haven't taken 7, you have taken 75% of 7. This 105 is called as cost inflation index, CII, cost inflation index. The government of India started to report this from 1981. So what have we done? These figures of CII are calculated on the basis of the consumer price index urban, but we don't take the entire CPI urban, we take 75% of that, which means every year we calculate this number and this number is reported by the government of India. And who uses this number? CBDT. CBDT is the one who does all this. So if you go to the CBDT portal in office, you will see that they are reporting all these numbers. So see, for 2001-2, this is the base. So CII is 100. Now for 2002 and 3, 105. So similarly for 2004, 113. So similarly for 2024-25, the reported number is 363. What is the meaning of this 113? The meaning of 113 is, if the price of this pen in the year 2001 is 100 rupees, the price of the same pen in 2004-5 is 13% higher. That's why 113. And the price of the same pen today is 3 times higher. So 100 rupee ka pen has become 363 rupees pen. That is the meaning of CII. Having understood this CII, let's go a little back. So I'm taking another example, right? So now let's see, suppose that in the year 2004 and 5, you purchased a house of 20 lakh rupees. Example. Now in the year 2024-25, which is this year, you are planning to sell this house for 1 crore rupees. Now government of India will come to you according to the new budget, and government of India will tell you that since you are going to sell this house, example, since you are going to sell this house and you bought it in 2004, it's obviously more than 2 years long-term capital gains. So government of India will tell you that, okay, since you're going to sell this, let us calculate what is the capital gain. So the capital gain becomes 1 crore minus 20 lakhs because you are selling it at 1 crore. So 1 crore minus 20 lakhs, 80 lakhs. 80 lakhs, right? So now Government of India comes and says that since this is long-term capital gains tax, immovable property, so what is the rate? 12.5%. So now Government of India will collect 12.5% of 80 lakhs, which is 10 lakhs. This is the tax you will have to pay. Now, why is there so much of objection to it? There is so much objection to it because of one fact, that the system that existed in India till last year was different. What was the system? I'll tell you. Now imagine, Bacho, I'm asking a question to you. Imagine that you have a pen in your hand today. Suppose today the price of this pen is 10 rupees. Going down the future, after 5 years, what will be the price of the pen? 10 rupees. No, the price of the same pen will become 17 rupees, 18 rupees. There will be natural appreciation of this pen because of inflation and other factors. So the real system that should have existed is that suppose there is a house whose value is 20 lakh rupees in 2004 and 5. Now suppose that I am interested in knowing that if I purchase the same house which I got in 2004 and 5 for 20 lakhs, if I want to purchase the same house in 2024-25, what is the actual price based on inflation, etc.? What is the actual price that I will have to pay? To calculate this actual price, we use this formula called indexed cost of acquisition. What is the meaning of indexing? Indexing means that you are making changes based on inflation and the price conditions. So whenever you take a phenomenon, and then, for example, here buying and selling the house is the phenomenon, and you are making adjustment related to inflation. So the house which you bought in 2004 and 5 for 20 lakh rupees, we are interested in finding out what is the actual price of this house this year, 2024-25. So the formula we use is index cost of acquisition. What is index cost of acquisition? It is cost inflation index for sale year upon cost inflation index for purchase year into the cost of purchase. And you remember, what is the CII of sale year? So our sale year here is 2024-25. So what is the index? 363. And for the purchase year, what is the index? 313. So what do? We take 363 upon 113 into 20 lakhs, 64.25. This number that you got is the actual price of the house that you would have to pay today. So if somebody will ask you that if you make adjustment for inflation is called indexation. That's a very important concept for UPSC, adjustment for inflation. So the 20 lakh house will actually cost you 64.25 lakhs today. But what is the price at which you are selling? 1 crore. So the real profit that you are making over the house is 1 crore minus 64.25 lakhs. Because making adjustment for price, the price of the house should be 64. But you are selling it for 1 crore. So what is the real profit you are making? 35.7. This is the profit over which the government of India, the government of India earlier used to collect 20% tax. So see, the old system. So according to old system, what the government used to do was, in the old system, the government used to collect 20% of adjusted or indexed profit. In the new system, the government says that I will take the final price at which you are selling minus the price at which you bought, which is 80 lakh rupees. So 12.5% of 80 lakh. But under the old system, the government used to say that, okay, you bought the house for 20 lakhs, but current value of the house is, let's say, 65 lakhs. So the government used to say, and you are selling the house for 1 crore. So the current price is 65, you are selling for 1 crore, which means you are taking 35 lakhs extra. So this 20% used to be charged on 35 lakhs. This system has been removed, which means earlier the 20% used to be taxed after taking into consideration indexation. Indexation means adjustment for inflation, but currently indexation is not provided. So let's come back and let's see the difference now. So same house, if you sell according to today's formula, you will have to pay a tax of 10 lakh rupees, but based on old formula of indexation, the tax liability was 7.15 lakhs. This was the debate which happened. The moment this debate happened, and I showed you that there was huge public reaction, the government of India made a few changes. What is the change that the government of India made? The change is, the government of India said that, okay, we are giving one relaxation to the people who bought the house before July 23, 2024. Because the current budget was presented on July 23, 2024. So Government of India said, anybody who bought this house before the budget was presented, and now if you want to sell the house, both the options are open for you. Either you want to follow old system of tax, which is 20% on indexation, or new system of tax, which is 12.5% without indexation. It's up to you. But if you have purchased the house or the property after the budget was announced, and then you try to sell it, you don't have a choice. You will have to pay the taxes based on new system, which means if you purchase the house before the budget was announced, either you can pay the taxes through this method or this method. But if you have purchased the house after the budget was announced, you have to pay the taxes according to this system. So now the Member of Parliament raised a concern, and he said that if the Government of India forces public to pay 7.15 lakh rupees, then there might be a reaction in the society where if somebody is selling a 20 lakh rupees house for rupees 1 crore, then it might be possible that suppose that I am selling a house to you. You are supposed to give me 1 crore rupees. What will I tell you? I will tell you, don't give me 1 crore rupees through check. Give me 30 lakh rupees or 20 lakh rupees through check, which is white money. The remaining part, 60 to 70 lakh rupees, you please pay to me in a bag full of cash. This bag full of cash will become black money. And why did I do that? Because the taxation is huge compared to earlier system of taxation. Hence, the Government of India had to roll back. But in the real sense, the rollback is not complete. It is only for a particular item in case of property which has been done. But otherwise, it's not a rollback in the real sense. So guys, this is how you pick up a concept from budget or documents or government policies and use it for your UPSC preparation by focusing on the right technical points. Thank you so much. See you in the next video.
So, I hope you went through the class and we all understand how important economics as a subject in this general studies, be it prelims and mains, is, right? And it holds a very significant number of questions when we look at the prelims examination. It is around 18 to 20, right? And that is a big number. Also in mains, it has 50% of weightage in GS paper 3. So you cannot ignore that, right? It is as important as any other GS subject. But few students have a jittery feeling, a fear of the subject. To make you familiar with this subject of general studies, we are here with our economics module for general studies that will be starting from 20th of September. The classes would be held for the duration of 4 months and it will be around 3 to 4 times a week. The class duration would be around 2.5 hours to 3 hours and the batch timing would be 7:30 a.m. Alright. Now this batch will be available in classroom as well as live online mode. You can choose either of them. Why this course? Because we understand your demand to understand the basics of this, know the concept and apply that knowledge in prelims as well as mains, right? So what does this program holds and how many phases we have divided it in? Okay, so for you, we have divided this program in 3 phases. In first phase, even if you have not prepared your NCRTs, you have not even touched any of them, you can come here and all of it, the basics will be covered in the first phase, right? Your base will be prepared. Now in second phase, all the core areas of economics will be covered, like public financing, banking, capital market, inflation, taxation, all the favorites of economics, right? The economic oriented general studies will be covered in this area, okay? In the third phase, whatever you have learned till now, you will learn the application. For example, you'll be practicing through MCQs for the prelims perspective and you'll be practicing through answer writing as well. So all of it will be covered in all 3 phases, right? And this is why you will be able to ace this economics in prelims and mains. So you do not have to worry, Vajiram and Ravi has got you. Enroll now as admissions are open. See you in the classroom.